backbone of the stock price, Apple, the biggest phone, software, and services company financial statement. Starting off with balance sheet. We are checking 7 metrics. Out of the 7, we got 4 metrics with good score. So, let's pop the hood on the financials. We need to see how healthy this company really is. First, let's look at the cash. It's actually the good news. They have money in the bank. In fact, they have enough cash to cover their debts. If they had to pay it all off, they could, and that gives them stability. But there's a flip side. When you look at how much they borrow versus what they own, it's worrying. The debt is high, way higher than the equity. They aren't just funding themselves. They're leaning heavily on debt. And historically, that's a red flag. Now look at the stock structure. It's clean, no preferred stock. They don't need that fancy, expensive funding. So that's a win. But then we get to the savings, the retained earnings. This part looks ugly. It's actually shrinking. They aren't keeping the money for a rainy day. It's going out the door. And if a recession hits, that makes them vulnerable. And speaking of shares, look at the treasury stock. It's sitting at 0. They aren't holding on to buybacks the way we like to see. That's another mark against them. But here's the twist. You have to look at the efficiency, the return on equity. It is absolutely massive. They're squeezing every drop of profit out of every dollar. And the assets? Same story. They don't just sit on things. They make their assets work hard. So, here is the verdict. They are leveraged. They are aggressive. But they are incredibly efficient at making money. Next is income statement. We are checking 9 metrics. Out of the 9, we got 9 metrics with good score. So, let's look at the income statement. This is where the magic happens. First, look at the margins. The gross profit is consistently high, over 40%. And you know what that tells us? Pricing power. They set the price, and customers pay it. Now look at the selling costs. The marketing, the overhead, is shockingly low. Why? Because the product sells itself. They don't have to chase customers. The customers come to them. And the research, the R&D, it is under control. They are innovating, but they aren't burning cash to do it. It's efficient. Now, let's talk about debt payments. The interest expense. It is basically nothing. It takes almost 0 profit away from the business. So the debt is there, but it doesn't hurt them. And the taxes? They pay about 18%. It looks standard. It looks credible. But here is the real winner. The net income. The bottom line. It is massive. Over 20% of every dollar stays in their pocket. That is a competitive advantage. That is a moat. And the growth? It keeps going up. Consistently. Faster than inflation. And if they had to pay off their loans, they could do it in a heartbeat. Basically in 1 year. So the verdict? This is a fortress. Next is cash flow statement. We are checking 6 metrics. Out of the 6, only 2 metrics got good score. So now we look at the cash flow. The real money. First, let's look at how they pay their people. The stock options. Sometimes companies print shares like crazy. They dilute your ownership. But here, it's disciplined. It's a tiny fraction. So, as a shareholder, you aren't getting squeezed out. That's the good news. But then, we see a disconnect. We compare the paper profit to the actual cash. Usually, you want cash to be king. You want it higher than the net income. But here, it's lower. The accounting says they made $1, but the bank account only sees 80 cents. And the growth tells the same story. The profits are running fast, but the cash flow, it is lagging behind. It's a warning sign regarding the quality of those earnings. Now look at the spending. The capital expenditure. This part is fantastic. They barely spend anything on equipment. They don't need huge factories to grow. It is a lean machine. But here is the final catch. And it's a big one. The rewards to shareholders. Dividends. Buybacks. They're paying out a lot. In fact, they're paying out too much. They're giving back more cash than they actually brought in. They're dipping into the savings jar. Or borrowing. Just to keep the shareholders happy. And simply put, that can't last forever. The combined financial score is good. 15 metrics with good scoring out of 22 metrics. Knowing just the financial statement is not enough. You can find the rest of the analysis on Apple, the biggest phone, software, and services company, in my channel.